Hello, I'm John Ward on behalf of Physical Gold Fund. Today I'm joined by three notable experts to discuss a topic of vital interest, the current state of the gold market. We're delighted to have with us here today Philip Judge, Managing Director of Anglo Far East. Also, Simon Heaps and Alex Stanzik, both of them advisors to Physical Gold Fund. Alex, let me turn to you first. You and I recorded an interview some 12 months ago in November 2013. Could you give us a high-level summary of what's been happening in the gold market since then, over this past year?
Hello, and sure, John. Last year in our interview, we indicated that essentially there was a substantial tightness in the physical market flows going through Switzerland. This was verified by an authoritative source. We were at the time concerned that there was going to be some kind of supply squeeze in the physical pipeline, so to speak, for gold. And as it turns out, that did not materialize. Right after that ramp up in flow tightness into the end of 2013, Chinese demand started to drop off. It essentially continued to do that throughout the middle of 2014. Then what happened is in June, the price of gold dropped below the cost of production for many mining operations, and then dropped even further below the global cost per ounce in October. So what we're seeing is since October, golds went in and out of backwardation, and in November, the 1 month rate has been that way, effectively a negative rate for 23 consecutive days.
Alex, could you briefly explain this term backwardation? What is it and why does it matter?
Sure. Basically, backwardation is a negative gold forward rate. And what that means is, in theory, if a trader wanted to arb this spread, essentially what they could do is they could sell physical gold now, they could buy it for delivery at some point in the future for a discount. And the idea there is it would lock in a profit virtually risk-free, assuming there was no default on that future delivery for them. So one way to think of it is kind of as a premium paid for someone desperate for physical gold now, and they're essentially willing to pay for it. And it sort of implies that players in the market feel that there's a small chance that gold may not be deliverable at that future time. So that's where it's kind of a risk premium, so to speak. According to an article I read today, the 6 month rate has been negative for 9 consecutive days, and that actually sets a new record. That hasn't happened in the last 25 years for which GOFO rates have been published.
What's the significance of that? What does it actually tell us about the market?
GOFO is an acronym, and it stands for the Gold Forward Offered Rate, which basically it tells us the rate at which bullion banks are willing to lend gold on swap for US dollars. So when you have some people in the industry refer to as backwardation is that basically means a negative lease rate, or someone is willing to pay a premium to borrow your gold now and give it back to you later, so to speak. The way a negative lease rate is calculated, though, is that you take what we call LIBOR, okay, the London Interbank Borrowing Rate, basically. You subtract it from GOFO, and if it is negative, that tells us that it's in backwardation. So this is not a precise science. It's basically a calculation set by different banks. It's subject to potential gaming by the banks involved that provide it. And what's happened is because of this, the bullion banks that have historically supplied the rates for the LBMA to establish this rate, they're going to stop reporting their figures. And the article that I read said that they're citing essentially regulatory scrutiny. There's been a lot of that lately. There's been a lot of revelations of different Forex issues in terms of market rigging, manipulation, etc. We know that LIBOR has been proven to have been rigged. It's still unknown at this point as to whether the problem has been resolved or not. So there are experts who believe, and I personally agree with this, that the current trend in market rigging is not going to get fixed without harsher penalties for individual traders versus a slap on the wrist or a fine for a bang. A bank is a corporation. It's got no emotions. Really, the only deterrent traders are going to have, because these traders can make millions of dollars in bonuses for fraudulent activity, those penalties probably need to be a little bit stronger than getting fired and getting to keep all the money they made. For this reason, it's hard to say how accurate these numbers are. What's most important about this really is that once the LBMA ceases to report these figures, there's going to be even less transparency into the physical gold flow than there already is. And the takeaway from that is that We are very fortunate to have relationships with a growing number of the world's key strategic players in the industry. So we have a bit more visibility into those situations.
So this is really a story about physical gold supply at some point. Is that correct?
Yeah, that's absolutely true. There are obviously a large number of factors that bear on whether physical supply is available or not, but ultimately it does indicate some tightness in the market, assuming that the figures are correct.
Well, talking of supply, Alex, you and your team, you draw on multiple sources of market intelligence, of course, and one of them is your very close relationship with a leading gold refiner in Switzerland. And obviously, the refiners have a pretty unique frontline view of the market, particularly, of course, issues of gold supply. Could you tell us a little bit about that relationship you have with the refiner in Switzerland?
Sure. AFE is the precious metals agent for the fund, and essentially it has relationships with refineries, multiple refineries throughout the world. But the main refineries we consider to be in Switzerland. And once a year or more often as needed, AFE essentially makes a trip over to Switzerland to participate in the audits of the gold under custody and for other administrative tasks involved with the logistics chain. During that time, AFE meets with key people in the industry. This year, the team spoke to the director of one of the largest refineries in the world. This gentleman has been in the refinery business for over 30 years. In my opinion, he has perhaps one of the best perspectives into physical gold flow of anyone else in the world that I'm aware of. We tend to think of the Swiss refineries as the core of the industry. They deal with physical flows coming from all parts of the world, not just specific regions. There are many different refineries throughout the world, but a lot of them deal mostly with their regional situation. The Swiss refineries actually interface with a good bit of the physical market globally. We tend to think of the Swiss refineries as the core of the industry. They deal with physical flows coming from all parts of the world. The analogy that we use is that if you can think of gold flowing around the world as a river, all of the sources of gold could be little tributaries, but they might be anything from mining, production to scrap to ETF, government sales, or even above ground stocks, which can become available for supply if the price rises high enough. But they all flow into this river, and the deepest part of that river is always flowing, even if the high water mark is up or down. The Swiss refineries are that deep part of the river, and having access to them gives us a better insight into what's happening in the physical industry than what most people will see looking at mostly stagnant inventories such as COMEX warehouses.
Thank you, Alex. Philip, let me turn to you as a gold bullion custodian for over 20 years. In that period, you've seen all sorts of ups and downs in the market. How would you place current conditions in a historical context?
John, it's a great question. It's great to be joining the call today, and it's really significant. You know, Alex a moment ago was just talking about backwardation, and from my experience, the last time I saw a market with the conditions that we're in today was in the 1990s. And what started to happen around 1996, we started to see a very, very similar setup to what we're seeing right now. At that time, there was manipulation in the market as well. It was quite different to today's manipulation. It was not so much a paper manipulation, although that did exist, but it was more of a physical market manipulation. Back in those days, it was being called the gold carry trade, and it really revolved around bullion banks leasing metal and then selling it into the physical market. And by doing that, they were managing to really hold the physical market price down. Today, as you know, even Alex has touched on already, it's quite a bit different, and the paper markets are so different nowadays. But what happened, and Alex touched on this a moment ago in terms of today's price movements just recently has taken the trading market price of gold to a point where it's below what the international average for many mining operations in the world today to mine at. In other words, the production cost is far higher than what they can actually get for it. So mines at that point are just going to start shutting down or slowing down their production to a crawl and so on. Now, the last time we saw this was in the late 1990s, and I can remember, you know, in those days, the international average for mine production was around $330 an ounce. It was a lot lower back then than it is now. And what happened was, from around 96, 97, sliding through to 98, 99, we saw prices come below that $330 an ounce, down to eventually, I think 1999, we reached about $255 an ounce. You know, I saw at that year a lot of exploration companies shutting down. You saw mines shutting down and closing down the plants. And what that did was that had a massive impact on the supply of metal, the mine supply coming into the market. So, we've seen that very same thing happening today. But on top of that, you've got to stack on top of that things like the backwardation that Alex has talked about, the amount of paper contracts that exist nowadays that didn't exist back in the 1990s. And, we're going to talk about today that the current market that we're in today cannot last forever, and there's a lot of reasons why. And in the 1990s, it didn't last forever either, and it ended in 2002. And in 2002, what happened was the gold price exploded from around 270 an ounce in the middle of 2002 up to 2012, where it reached 1,750 thereabouts. So between 2002 and 2012, we saw an increase in the gold price of around 550% in just 10 years. In fact, if you even take today's gold price at what many people say are depressed or suppressed prices, at least compared to that peak of 2012, we're still about 350% up from that 2002 price when the game ended. And part of what I explained, this 550% growth between 2002 and 2012, I put that down to what was being structurally set up in the physical market from that period of 1996 to 2002. What happened in that period of time in the physical market explains a large amount of this very significant growth we've had in the last 10 to 12 years. So I think really today's market is similar but far more acute and far more exaggerated to what I saw in the 1990s. Another point that is really important here is that Alex just a moment ago talked about the importance of the relationships that we have with the Swiss refineries particularly because they see firsthand inside what's happening around the world. What supply is coming out of the West, where it's coming from, what mines are shipping in, from their production, what's going to China, what's going here and there. And that's really important and strategic information that we're, very uniquely gifted to have access to. A couple of weeks ago, as we've already mentioned, Simon and myself were up speaking with the managing director and treasury director of Switzerland's largest refinery, which makes it the largest also in Europe. And we were sitting down, we had a good chat with him, and he opened the conversation, and this really rocked me, rocked Simon and myself. He said, in my 30 years or over 30 years in this market, I have never seen a market like this. And then he went on to say there's something terribly and structurally wrong. And then he said later on is that it cannot last forever, but when it ends, it's going to be messy. Those are very significant statements for a gentleman who's so well connected to the real physical side of this market, John. And again, over 30 years in this industry, I've never seen a market like this. Something terribly and structurally is wrong, and it cannot last forever, and when it ends, it's going to be messy. And he went on to talk about the massive demand coming out of China's number one, China, and far, far greater than what's been officially reported. And, I know Alex has talked about that before. Of course, then there's still huge demand coming out of India, and then Middle East, and even Russia. Even last night, I was speaking with a CEO of a publicly traded oil and gas company, and he used exactly the same language. He said the global commodity and energy markets have gone from terrible to outright scary, and there's something really wrong out there. So, that's just further validation to, I think, the market conditions we're in right now, John.
Let's just stay with that fascinating aspect of it for a minute, Philip, because the gold market, as we know, has two major aspects. There is the physical market for the metal itself, and then there's the paper market. Could you tell us a little bit about how you see the present-day relationship between these two aspects of gold, physical and paper?
Yeah, great question. And, to start with, we've got to see that when we look at the gold price and we see it on the internet or TV or whatever, what we're really looking at is the paper market price of gold. And the reality of the situation is that the physical market is completely different. Alex was talking about this a little bit earlier when he's talking about backwardation. Well, let's start with the paper market. What's the paper market made up of? Basically, it's paper contracts, futures, options contracts. You've got CFDs, all of these paper derivative instruments which are traded by velocity traders, trading usually algorithms. And so really, if you were to summarize the paper market, it's really made up of speculators using paper, trading paper backwards and forwards. The physical market, on the other hand, is completely different. It's made up of market participants. And if you want to look at a market participant in the physical metal, you're going to look at miners, there's going to be refiners, there's going to be buyers of the physical metal, whether they be watchmakers or electronics companies or investment companies or whatever. There's a very big difference between those two markets, even by the people that are in them. Again, the paper market is a derivative. If you look at when paper markets started and how they started, you'll see that they were derived from the original core commodity market, whether it be wheat contracts or gold futures contracts. They're all derived from the physical market themselves. So there is a link between the two. But at the same time, there's a huge, huge disparity between the two today. If you look at the physical market of physical metal and the paper market, you'll see they're completely different, John.
So you mentioned the price of gold that we see when we watch television or read our newspapers is basically delivered to us by the paper market, by the market in futures. And then there's the physical market where you have this massive demand, particularly from the East. So can you help us understand the sort of mismatch? Because if there's huge demand for the physical metal, why is this not reflected in the price in the paper market?
Well, again, because the paper market, and, Alex talked a bit about this earlier, but the paper market is really being priced by the trading, the shorting, going long, the trading of paper contracts, which, while they are linked back to the physical market, it's not actually determined by the real factors that affect the physical market, which is supply and demand. And what we're finding here, and this is why a refinery chief of one of the biggest refineries in the world will tell you that there's something very, very structurally wrong out there. And when it ends, it's going to be messy because he's talking about this disparity between the two markets. Of course, what that's being reflected in today is that all the major refineries around the world are running 3 shifts a day, 24 hours a day, 7 days a week, just to keep up with the demand when they can get enough source metal. So I'll come back to that in a minute. But one thing we're seeing in the physical market is there are delivery delays on minted and refined production. That's probably getting more and more acute, actually. And the lower these prices drop, the greater the demand increases for the physical metal, harder it is to get the supply, and the longer it is to actually get the delivery of the minted or refined product itself. Sourcing the metal is a huge issue. This came up again with the refinery chief we were speaking to, and he's saying it's one of the biggest challenges right now is where they're going to get source metal from to meet the demand that they've got. And of course, we've always got to remember a refinery production is entirely dictated by the availability of the supply of metal itself. 18 months ago, John, I sat next to the chief of the bullion operations of one of London's large banks, and he was telling me at that time that inventories in London vaults are still quite high. And what we've seen over this last 18 months is that there's been a massive warehouse depletion to the point where, the refinery, the conversation we were having in the refinery the other day, a couple of weeks ago, he was saying that you've seen bars coming into the refinery now that haven't been in circulation since the 1960s. So what that reflects is the fact that these vault reserves are getting so low now because they're just getting empty. So that's where you start to see these old bars coming back out and sent back to the refineries for re-refining. And so that's a big indication of the fact that there's just such a depletion on the supply side of the physical market. And again, one thing I always have looked at because of the research background I came from was mine supply and look at what the mines are doing. And of course, if you see a large amount of mines where the market price of the physical metal is below their production cost, they're just going to shut in and wait. And we're seeing that happen today. And the problem there is that it takes sometimes years to get some of these mines back into operation. And what that does is that has a huge, huge impact on supply moving forward. Even if prices come back up and we start trading above the average international cost price per ounce, it still takes many, many months, if not years, to get that supply back into the market.
So let me just get hold of this. What you're describing is a truly extraordinary situation, a massive demand for a product, gold, a squeeze on supply, and in sort of normal everyday economics, that would mean upward pressure on price. I mean, that's just common sense. When there's huge demand and contracting supply, the price goes up. But we're not seeing that. We're seeing this mismatch between the demand-supply story and the price, and that's because of this relationship between the physical and the paper market. And if I'm hearing you right, you and your contacts at the refineries are saying this is an unsustainable mismatch. Something has to break here. Is that correct?
Yeah, correct. That's the only way it can be answered because, the paper market can trade wherever it likes, but physically to supply demand, you've got to have metal, you've got to have refining capacity, and when the market is artificially driving those supply-demand factors in opposite directions, eventually it's got to break. And when it breaks, that's when it gets messy. And I think a very small example of this was the 1990s that I refer to, where we had 6 years of physical manipulation. And when that ended, then we had that, 550% explosion in prices. And I think what's happened is the amount of impact that this last 18 months or 2 years has had in the physical market is far, far larger than what we saw in the 1990s. So the potential on the other side of this is far, far greater. So maybe we're talking far beyond 500% increase from these prices. It's really hard to say, but certainly something dramatic has to happen at some stage. In the meantime, what happens is the disparity between the paper and physical is reflected in premiums and so on.
So, Simon Heaps, let me turn to you and ask you about that and for your insights on this extraordinary story of supply and demand and pricing in the gold market.
Hi, everyone. Good to be on the call. Yeah, John, I concur with exactly what Philip was saying. We're seeing, there's even premiums on rapid delivery. The refinery that we were at, they're talking a 4-week production cycle. But just to switch back to what Philip was saying, the difference, what's happening between the physical market and the paper market is basically the traders that are working for these institutions and, also working on their own. A trader by nature, it's natural for them to exploit whatever they can because that's what traders do for profit. And they don't care about supply demand. They don't care about the fundamentals. So we're getting a lot of this happening in the options futures market, and it's getting to the point where something is broken. And it's to use the words of the CEO of the refinery, it's going to take probably someone in the COMEX taking delivery, and then the game's over and the whole thing's going to be exposed.
Could you explain exactly what you mean about someone in COMEX taking delivery? Just spell that out for us.
Well, on the COMEX, there's supposed to be a measure of metal behind each contract, but they never take delivery because it's traded. What it would take is someone actually taking delivery on those contracts, a sizable amount. And if COMEX cannot deliver, then you're going to have an issue. But probably they'll change the rules and say we'll only pay cash. And again, that will expose to the markets that the game's up. And a lot of people are coming around to it now. And we know that because the physical side is just on fire. Like Philip said, 24 hours a day, 7 days a week, these refineries are running out bars coming back in from the 1960s. That means it's coming from the back of vault. Not only that, we're getting reports out of other gold centres like Dubai where they're having trouble getting physical. When you start to look at it and then you combine that with the mining companies around the world, in the top 5 largest providers of physical gold in the world from the mining supply would be Australia, and 60% of that goes to China. And we're hearing rumblings now out of Australian mining companies that they're talking about shutting the mines in until the price comes up. At the end of the day, supply-demand will rule, but when is the question. We know it's going to happen. It's not a matter of if, it's just when. And being able to sit this thing out long enough for when it does happen.
Well, it is a remarkable story. And Philip, Simon just mentioned this massive demand for gold from China, and we read about, of course, demand from Russia, which has been much discussed recently in the media because of tensions with the United States and issues around the dollar, and other countries around the world, but does not seem to be a significant demand for the physical metal from the West. Can you help us understand this mismatch, this difference in physical demand between East and West?
That's a great question, John. And, different people would probably answer that question differently. The way I'd like to look at it is that it really represents mindset. And I think what we see in the Far East and the Middle East is a thinking that is more long-term and it's more strategic. It's really considering where's the world going to be 50 years from now and how can we position ourselves for that. What I think the Western mindset is so different. It's more of a immediate, quick gratification, short-term thinking. You could almost call it a debt-based bankrupt mindset. And so what's happening is we're seeing all of this demand we've been talking about on today's call is all basically gold heading from the west to the east, and it just reflects the mindset. And today you go to most Western investors, apart from the sophisticated smart guy, most people are thinking about their next holiday or whatever, and they're looking for short-term profits, and they've just got their eye on the wrong thing. They've lost the long-term strategic thinking that we see in the Far East and the Middle East. So I think that's the real issue here. Again, Simon was talking about a moment ago about the trading mindset, and I think we've already mentioned that all the bullion desks and the trading desks of the big bullion banks and financial institutions that have traditionally been in physical metals, all the experts have now left those markets. These are long-term professional gold and silver traders that knew the physical market, and they'd been in it for many decades. And we keep referring back to the conversation we have with the CEO of the refinery the other week, and he's a long-term professional that's been in this industry coming up 40 years. And he made this comment himself. He said all of the bullion banks in London or wherever, these are all nowadays run by guys in their early 30s that are all velocity traders. They don't know the market. They've never visited a refinery, never visited a mine or been inside a security vault and been at a bar audit. They just don't know the business that they're in. They'd be just as happy trading currencies or, pump dump penny stocks as they are precious metals. All they want to do is get the trading the paper instruments. So, we're at a very interesting time in terms of the mindset of the West. And really in a longer term sort of outlook, it just really reflects where we'll be in terms of the geopolitics of the world over the next 50 years, I think.
Well, Simon, let's turn to the future for a minute. And we've talked about here a situation which we've agreed and which common sense now tells us is unsustainable. There's so much contradiction in the picture between demand, supply, price, paper markets, physical markets, east, west. Everything is in contradiction here and something is bound to break. But help us look forward. What might this look like? Nobody can know the future, but we can use as much wisdom and knowledge of the past as we can to attempt to anticipate what might happen. What do you see as being the point of change and how things might look when all of this begins to transform?
Yeah, John, I think it's a matter of perception of value. And, when we look at all the indexes today, the gold price, the Dow, the S&P, the currencies, our entire perception is based in these indexes on value. And, we've already been talking about how the paper side, the trading side of the market is just so disconnected from the real physical, tangible supply-demand side of the market. I've got to the point where I just don't trust these indexes anymore. I don't trust the gold price, what's being reported. I don't trust the stock market prices, the currency values. They're all over the place. Again, it's coming back to perception of value. And so going into the future, to me, I would sooner own the physical, regardless of the price. Even if it went down to $800 an ounce, I'd still sooner have the ounces, the real stuff. To me, that future's already here. It's just that the crowd hasn't woken up yet. And it's going to take some key catalysts to probably do that, which are not going to be very nice. That's where people need to be looking into the future now, is physical acquisition. And forget about the prices, forget about what the indexes are saying. Just look at the supply-demand fundamental and take a hold of the physical. Definitely our perception on this side, working in the physical side of it, especially on the institutional buyer level. Okay, so it's one thing to buy coins and small bars and things like that, but investment grade metal, where we're running into the tens of millions of dollars, it's getting very difficult to start to get into those areas and actually take delivery. That would be my perception on the future for people to look forward, is don't be deceived by the current prices you're seeing. Keep coming back to the supply-demand fundamentals, because there's a war raging in this area and you're going to see lots of battles, but the war is going to be won by the supply-demand side of things, and we know it's way short at the moment. So that would be my take for people into the future.
Well, thank you, Simon. And Alex, let me ask you also, what would be your view and your perception on the best advice for investors in the current market conditions?
John, I think that after the back and forth that we've had a lot of discussion about the difference between the paper market, the physical market, et cetera. I pay attention to a lot of different sources of data information. I also try to keep track of sentiment as much as possible. Something that I think is important for people to understand is that sentiment is different based upon where you are. In other words, the sentiment or the market narrative, so to speak, for China when it comes to gold and the Chinese people when it comes to gold is very different than the sentiment and the narrative that these people are discussing and telling themselves and believing compared to India, for example. And that's also very different from the sentiment and the market narrative that the West is using. And when I say the West, I'm lumping all of the West together. Granted, I know that there are individual markets and they all think very differently. So if you lumped the French in with the United States, both of them would probably not agree with that. But in terms of how the West buys gold, the West is basically one gigantic block of sentiment as far as I've been able to see. Right now, the sentiment, the narrative in China is buying a tremendous amount of gold. India has been that way for as long as I'm aware of. It's a very culturally ingrained situation. And if you talk to refineries around the world, they'll tell you that India has always been a huge source of demand for gold on a regular basis. That kind of slowed down a little bit after the tariffs were imposed by the government over there. And now China has become the most massive consumer. But in the West, you asked this question before about how the West, there's not that much demand for the physical, and that's absolutely true. It's because the narrative, and Simon mentioned this, it's psychology. The narrative in the West is that it's not important. Everybody is so focused on the SPX and the Dow and the NASDAQ continuing to go up and up and up and up and up and up, that in the West, money has been taken out of hard assets like gold and other things and has poured into those areas. And that's where they're focused on. That's all they're viewing. And so that's one aspect of it. But the other aspect is the reservoirs of gold is important to note as well. And what I mean by that is that Simon mentioned that it might take something drastic like a failure to deliver on COMEX. And the thing is that if you look at the various different kind of pools of gold around the world, they are elastic, they stretch and they change. And the biggest pool is that there's some 165,000 tons of gold above ground. A lot of that's already accounted for, but there are tens of thousands of tons of gold that are available for sale. Somebody owns that already. It can come on the market in the form of supply if the price goes high enough. What will force the price higher is if those people believe that they should hold on to it and that the demand shifts. So the demand in China is huge. The demand in India is huge. What it will take is the sentiment, the narrative of the West to shift. And I don't think that COMEX is a good way to gauge the price of gold. This comes back to that whole pricing disconnect. There's a lot of traders that I know who think that's absurd, who say that, you know, it's a two-way market. If there's a buyer, there's a seller. If there's a seller, there's a buyer. If there's somebody short, there's somebody long. And that it's just ridiculous that the paper price is disconnected from the physical price. But I would like to point out that these reservoirs are measurable. In other words, for GLD, just as an example, the inventory in GLD has changed this year alone with the price of gold, almost 90 tons peak to trough. However, if you look at the COMEX inventory, it's basically a flat line compared to that. And I think that's really important for people to understand, because COMEX is where the price is derived for the world. And if the inventory in COMEX is not growing and it's not shrinking based upon the price of gold, how do these guys really know what's going on in the physical market? So I think that's an important thing for people to understand. And then finally, to get to answer your question, I think it's important right now that people focus on the physical, because we have example after example after example after example of the entire global financial spectrum. All measurements are completely out of whack, with massive volatility in every market, including bonds. Now you look at what's happened recently with the bond market, where there was a high frequency trading incident, and the entire system is incredibly volatile. And these indices, I think, are, just like Simon said, are no longer accurate of what's actually true. Some of them have been tampered with. We have many facts and examples of that recently. Fines have been levied on many banks over and over and over again. It's almost like a consistent freight train of facts of all of these fines that are coming out for everything from Forex rigging to LIBOR to precious metals rigging, which, by the way, that whole manipulation thing, there's a lot of people who have poo-pooed that for years, but as it turns out, it's true. We have many of examples of it in terms of fines and proof that regulators are finding right now. And at the end of the day, when this all settles, because it's going to settle one way or another, the only way people are going to be safe is if they have physical.
Thank you, Alex. Philip, let me turn to you last of all, and let's continue this conversation about the investor viewpoint, particularly, I think, institutional investors. What you would advise institutional investors to be anticipating as possible future outcomes, and what preparation would be wise to make?
Yeah, again, a good question. In fact, it came from the mouth of the refinery CEO the other day, and it's something that Alex, Simon, and myself always talk about. Simon said it, and I'll just say it in slightly different words. Don't be concerned about the price, but think more about how many kilos, how many ounces do I own, whether that be physical or if you're in a fully gold-backed physical fund such as the physical gold fund, where every share is backed by defined actual real amount of gold, then how many shares do I hold, and therefore how much defined gold behind that? And that's the question to keep getting back to. I think one thing that's come out in this call is the fact that there's some real structural problems overhanging this market, and when it stops, as Simon called the end game, whether it be somebody trying to take delivery in the COMEX or somebody trying somehow to push it to a short squeeze, we've already got the short squeeze is already here, but it's just not flowed out yet. And when it happens, the prices are going to absolutely explode. They have to. And even if you took the 1990s scenario that I've talked about today, and you see that upside of 550% growth, I think this next time around, when the music stops and there's not enough chairs in the room, I think the upside is going to be huge. But it's just a matter of patience. And I think the other thing to think about is applying the mindset of the Middle East and the Far East in terms of the strategic outlook. So I would say to people positioned in gold, and if you're well positioned in gold at this time, then you're at the right place at the right time. I don't think you're going to have to wait too long to see some dramatic upside, and therefore the patience paid off, John.
Thank you, Philip Judge, Simon Heaps, and Alex Stanzik. And thank you to our listeners. On behalf of Physical Gold Fund, this is John Ward saying goodbye for now. We look forward to joining you again as events unfold in the coming months.